You're scrolling your phone at 11 p.m. Someone in a comment section swears this stock is about to explode by Friday. Your thumb hovers over the buy button. Meanwhile, in an old interview playing quietly in another tab, a billionaire investor is saying something completely different. He's not chasing anything tonight. He hasn't chased anything in decades. And somehow, that's exactly why people started calling him at 2 a.m. for advice. That's the part nobody screenshots and shares. 10 of the richest investors alive built their fortunes on 10 very different rules. One waited years for the right moment to even move. One did more homework than most people finish in college. One bet real money on something so strange it sounded like a joke at the table. But strip away the industries, the decades, the headlines, and something strange starts happening. The same idea keeps showing up, quietly hiding inside 10 completely different decisions. You won't spot it yet. Neither did most of the people standing around these investors, back when they still looked like nobody worth watching or believing in. Go back to that phone, that comment section, that stock everyone says is about to explode. Warren Buffett has spent decades watching people make exactly that decision, and he still says the same thing every time someone asks him for the secret. There isn't one. It just takes patience, and most people simply don't have it. Buffett has talked about this so often, it barely counts as advice anymore. More like a warning nobody wants to hear. Given the choice between a lottery ticket that might pay off next week and a slow, boring path that quietly compounds for 30 years, most people take the ticket. It feels better in the moment. It photographs better too. Nobody posts a screenshot of a savings account growing by 2% a month. This is where the status shift starts, long before the money shows up. Patient investors get called boring by people who are, at that exact moment, still chasing the next tip. Gus Levy, the old Goldman Sachs partner, put it simply: be a long-term greedy person, not a short-term greedy one. Chase short-term, and long-term results tend to disappoint you eventually. The people around Buffett didn't understand this for years. They watched him hold when everyone else sold, do nothing when everyone else panicked, and assumed he simply got lucky over and over again for 6 decades straight. He didn't. He simply refused, quarter after quarter, year after year, to play the same short-term game everyone else around him kept playing without question. That refusal is rule 1, and it's easily the quietest, least exciting rule on this entire list. Patience alone doesn't build $1 billion. Mark Cuban has been direct about this in interviews for years. When someone once asked him straight up if he could start from zero today with everything he knows now, could he still become a billionaire, his answer wasn't the confident yes people expect. He said no, not unless he got lucky again, because the honest truth is there are only a handful of real paths to that level of wealth. You start a hedge fund and hope it works. You take a company public. You build something private and get bought out. That's essentially the list. Cuban wasn't being modest. He was pointing at something most people overlook completely: that being a billionaire requires finding something genuinely useful, or something that simply explodes financially. And plenty of very smart people try every single one of these paths and never get there. The ones who do rarely look special from the outside beforehand. Nobody watching closely at the time could ever really point to them in advance with any real confidence. This is the exact milestone most people misunderstand. It isn't about working harder than everyone else at every available opportunity that happens to show up. It's about correctly identifying the one rare opportunity that's actually worth all the risk, then committing to it completely and fully, instead of spreading yourself thin, chasing every single opportunity that walks past your door, quietly hoping one of them eventually somehow works out in your favor. Cuban found his opening. Sam Altman thinks about what you do once you're already inside one. His view is simple, and he's repeated it plainly in interviews. The single biggest edge any investor can have is a longer time horizon than everyone else around them, and a real willingness to sit with more illiquidity and more volatility than most people can stomach. That sentence sounds obvious, until you actually try living by it. Watching a position sit perfectly still, or even drop, for years, while everyone around you moves in and out, chasing quarterly noise, takes a specific kind of discipline most portfolios simply aren't built for. Altman has talked about investing in things meant to matter across generations, not just across a single earnings cycle, the kind of position you'd be comfortable handing down to your own kids one day. Very few people out there actually structure their own money that way at all. Most treat every investment like it needs to prove itself within months, checking prices daily, reacting to headlines weekly, exhausting themselves over decisions that were never meant to be evaluated that quickly in the first place. The families who think in decades tend to look, from the outside, almost uninterested in their own money. That specific kind of disinterest is the entire point. It buys them time, and time is the one variable nobody has figured out how to shortcut, no matter how much research, capital, or raw talent gets thrown at the problem instead. Altman's patience only works if what you're holding on to is actually worth holding. That's where Bill Ackman comes in, and his approach looks less like investing and more like detective work. Back in 2016, Chipotle had just been hit with a serious food safety crisis, and its stock had fallen roughly in half from where it once stood. Most investors saw a damaged brand and walked away. Ackman saw a strong concept customers still loved, paired with a price no longer matching reality, worth investigating before committing real money. His process wasn't a hunch. He's described starting with the company's SEC filings, the annual 10K report, and the quarterly 10Q reports, along with the proxy statement that lays out how the board actually governs the business. Conference call transcripts get read too, often going back 5 years, because hearing what management said they'd do, then checking whether they actually did it, tells you more than any single earnings headline ever could. Ackman has called it something close to a large research project, stretching into competitors, industry dynamics, and conversations with people who actually understand the space when it's unfamiliar territory to him. Sometimes that means calling on expert networks, people willing to explain one narrow slice of an industry in real depth. Sometimes it means simply listening to a founder's own podcast interviews, because how someone talks about their business, unscripted, tends to reveal more than a polished press release ever will. This is the part most people skip entirely. It's slower, less exciting, and doesn't fit neatly into a single scrolling video. But it's also the reason research-driven investors aren't just gambling with better vocabulary. They're steadily reducing how much they're actually guessing. One filing, one transcript, one uncomfortable question at a time, long before any real money changes hands. Ackman's research tells you what's worth risking money on. Grant Cardone's rule tells you what kind of money you should even be risking in the first place. And here's where the contrast really sharpens. Cardone has been blunt about consumer debt, calling it terrible, self-destructive, the kind that funds a car you can't actually afford, or holiday gifts bought on borrowed money you'll still be paying off in spring. If you want something like that, he's argued, rent it instead. 24 months of payments on a car you can't otherwise afford tells you plainly that you can't afford it at all. That's bad debt under his framework because it doesn't invest in a better future. It just quietly drains the one you already have. Good debt looks completely different. It's borrowing to buy an investment property where a tenant's rent covers the loan every month. It's leverage used to acquire something that generates its own income, rather than something that only ever costs you money as it sits there deprecating in your driveway. Cardone has described structuring his own finances almost entirely around this distinction, chasing debt tied to real assets while avoiding anything tied purely to consumption. The uncomfortable part is that most people can't easily tell these two apart in the moment, because both feel identical at the register. The same swipe, the same signature, the same brief rush of getting something now instead of waiting. The difference only shows up months or years later, in whether the debt quietly built something that keeps paying you back long after the purchase, or whether it simply followed you home and sat there, costing you a little more every month for years, with nothing to show for it beyond the original thing itself, slowly losing value the whole time. Good debt, in Cardone's framing, only works if it's pointed at something that pays you. That idea is basically the entire foundation of Robert Kiyosaki's whole model, the one he built his career explaining. In his framework, a paycheck is just money you trade hours for, and the moment you stop showing up, it stops arriving. Cash flow works quite differently. It's money that keeps arriving whether you personally show up that day or not, coming from rental income, from a business that runs without you standing behind the counter, from assets that quietly generate their own return. Kiyosaki has openly described the real trick as figuring out how to stop working directly for money and instead build enough cash flow or income streams that money essentially works for you around the clock. This is his own framework specifically, not a settled accounting rule everyone agrees on, and it's worth saying plainly. But the identity shift underneath it is what people notice first. Someone whose income depends entirely on a job title gets treated one way. Someone whose income keeps arriving, regardless of whether they're even in the building that week, tends to get treated very differently by everyone around them, often before anyone fully understands why that shift is even happening. It isn't about the size of the number. It's about where that number is actually coming from, and whether it needs you personally, every single day, showing up, clocking in, trading more hours for it, or whether it's finally learned to stand on its own 2 feet, quietly running in the background, without your constant attention or approval. Cash flow gives you steady income that doesn't depend on you. Howard Marks has a rule about the money you're actively investing that sounds almost too simple to matter, and he's repeated some version of it for decades. Invest a lot, invest early, and just keep going. Don't try to be a genius. Don't try to be clever about jumping in and out. Almost nobody can actually do that well. And if you happen to sell right before the market drops, Marx has pointed out that's usually closer to luck than skill. Most people who sell before a drop congratulate themselves for being brilliant, then quietly forget to get back in, and end up missing the recovery that almost always follows. Marx has been clear that timing the market is about the hardest thing there is, and his advice is simply, don't attempt it. You can adjust how much risk you're comfortable carrying, but the market itself is made up of people, and most of those people aren't foolish. If enough of them already know something, acting very differently from the crowd rarely turns out to be right, unless you happen to be genuinely exceptional, which relatively few people actually are. Marx has said he's personally made maybe 5 real macro calls across 50 full years of investing. That's the real ratio behind confident-sounding predictions. Everyone thinks they can accurately call the next top or the next bottom before it actually happens. Almost nobody actually can, not more than once or twice across an entire career, no matter how confident or convincing it happens to sound in the moment. Marx says, stay invested and don't try to be clever. Ramit Sethi's rule is about making that actually happen without relying on willpower every single month. His view here is pretty straightforward. He thinks everyone should have an investment account, and for most people, that starts with something already sitting right in front of them, a 401k through work. Once money lands inside one, it behaves almost like a bank account, except you're the one choosing where it actually gets invested. Beyond that first account, Sethi points to a Roth IRA, which comes with tax advantages that used to feel reserved for the ultra-wealthy, but are actually available to plenty of ordinary earners. Eventually, there's a standard taxable account too, where you can hold the same kind of investments, an index fund for instance, as anywhere else. The real unlock, though, isn't picking the perfect account. It's setting the whole thing up to run automatically. So money moves into investments every month, whether you remember to log in or not. Sethi has described discovering this idea for himself as a teenager and simply letting it run quietly in the background from that point forward, compounding for years without requiring a single manual decision on his part. That's the part most people abandon. They mean to invest consistently every month. Then life happens, And the manual habit quietly falls apart within just a few months, long before it ever really had a real chance to compound into something meaningful over time. Sethi's whole system runs on stocks, index funds, the usual building blocks. Ray Dalio's rule points somewhere most people overlook entirely. In his more recent public comments, Dalio has recommended holding somewhere around 10 to 15% of a portfolio in gold, a noticeably higher range than what he suggested years earlier, as his view on risk in the system has shifted over time. His reasoning here centers mainly on debt. Dalio thus pointed to a monetary system built after World War II, one where currencies carry real risk simply by existing, tied to government spending and debt levels that keep climbing. Gold, in his framing, works as a diversifier against exactly that risk, something that doesn't depend on any single government's promises holding up. He's been careful to frame it as portfolio balance rather than a prediction about any specific crisis arriving on schedule. Most ordinary retail portfolios hold little or no gold at all, weighted almost entirely towards stocks and bonds instead. Dalio's argument isn't that gold should dominate a portfolio. They clearly shouldn't, but that a meaningful slice, sitting quietly alongside everything else, changes how the whole thing behaves when other assets fall at the same time. It's the one rule on this entire list that isn't really about growth at all. It's about what's still standing quietly when everything else around it, briefly, isn't holding up. Dalio hedges against catastrophe. Kevin O'Leary's rule is about the opposite end entirely, the strange little bet nobody else wanted to touch. In 2019, a founder walked into the room asking for money to sell cat DNA tests for $29. O'Leary's first reaction was blunt. Why pay that much when you could just buy a new cat for $5 instead? He said yes anyway, taking a modest stake for a relatively small amount of money, reportedly somewhere in the low six figures. The company, Basepaws, kept building, expanding into dogs, growing its genetic database. Years later, it sold to an animal health company for more than $50 million, turning that small, almost embarrassing bet into one of O'Leary's best returns by percentage, by his own account. Here's where the loop from the very beginning finally closes. Buffett waited. Cuban searched for the rare door. Altman held on for decades. Ackman dug through filings nobody else bothered reading. Cardone separated debt that pays from debt that drains. Kiyosaki chased income instead of a title. Marx refused to guess. Sethi automated what willpower kept failing to do. Dalio hedged against the whole system breaking. And O'Leary, when the bet looked genuinely ridiculous on paper, still ran the numbers instead of laughing it out of the room. Every single one of them, in their own completely different way, took a carefully calculated risk instead of a reckless one. Never a blind one, and never a wild guess dressed up as confidence. So which one actually fits you? Maybe it's Buffett's patience, sitting still while everyone else scrolls for the next tip. Maybe it's Ackman's research, reading filings nobody else bothers opening. Maybe it's O'Leary's willingness to take a small, strange bet seriously instead of dismissing it early. None of these rules require you to be wealthy before you start using them. They just require picking one that actually matches how you think, then sticking with it long enough for it to mean something. That's usually the part people skip. Not the picking, the sticking. Drop a comment with the rule that felt most like you. Patience, research, automation, whichever one landed. It's useful to see which ones people actually connect with. And if these kinds of breakdowns are helpful, more of this series is already in motion. Real decisions, real numbers, explained the same way. No pressure, just something to come back to whenever you're ready for the next one. 10 rules. 10 completely different people, one shared habit underneath all of it. Calculated risk over blind guessing.